Hello people, Dr. Wang is here recording. In this chapter, I'm going to introduce you the accounting information systems. And this is a lightweighted chapter which does not require a lot of practice for accounting procedures or a lot of hard concepts to memorize. So what is the accounting system do we use in the business world? So what you see here first is to identify the principles and components of accounting information systems. So right here, that's your system principles. You have different principles to follow. You need to obtain efficient control for your accounting and also make sure the transactions and activities recorded here are relevant. And also your system is compatible to the other business operating system of your company. And of course, you need to have this flexibility to make sure whenever there's an update, it could be incorporated in a timely manner. And also cost-benefit principle, make sure it does not cost too much while it can bring you enough benefits. All right, so the system components we have here is first, you need to find the source documents. It could be either an invoice or a receipt or any sales paper or transfer ownership, that kind of documents. And then you're going to put it into your devices, usually through a scanner or just put in a computer through keyboards. And then you will use the IT to process the information. And of course, you have to utilize the software for it. And then you're going to store the information. Nowadays, we don't just store in the hard drive. Instead, we store it on cloud. So people can just share the information wherever they go. And of course, at the end, we want to present the information to the decision makers. You also need to have output devices. So for processing the information, you need to have some computer language skills or C++ or Python. And then to present it, you also need to convert those computer languages to words or PowerPoint. So here are the journals we use. You know, in the previous chapters, I keep talking about the general journals, journal entries, and general ledgers. So this is the forms or the just the outlook of the journals you see. So you have a sales journal and cash receipts journal and all the other journals connected with the transactions. And of course, you have a general journal which for transactions that is not in specific journals. All right. So describe the use of controlling accounts and subsidiary ledgers. So if you still remember, then we covered this general ledger. So ledger basically is for different accounts and for all kinds of debits and credits combined together for this particular account. So you have subsidiary ledgers can be divided based on the characteristic. So whether it's due from the customer, it's something you need to collect, or is the amounts owed to creditors or something you have to pay. So in terms of a controlling account, it can be divided into accounts receivable or accounts payable. And then you will have a subsidiary ledger built for each particular account. So here is the general ledger for account receivable and also general ledger for accounts payable. And that combines all the debits and the credits, as you know. And you can divide it into different vendors and different sellers. So here is the different companies you need to collect your bill from. And also here are the different companies you need to pay your bill to. All right, so subsidiary basically means you're going to further divide your ledger based on the companies you have a relationship with. And here is a definition for all of these journals and ledgers. There's nothing more I can add here. You just need to memorize the definitions. So here I give you the key. For example, the general journal is all-purpose journal in which we can record any transaction, right? And then for the special journal, it is used to record a post-transaction of a similar type, like account receivables or payables. So this is something we have done before, and we have done a lot of exercise on this, and I have been mentioning them all the time. So it's really up to you to remember the definition of all this. And I will for sure give you questions conceptual questions in your test on this topic. All right, so how to journalize and post transactions using special journals. So this is a sales journal. So these are the people who buy things from you, and they will pay you in the future. So whenever the sale is incurred, is recognized, then you will build a account receivable as a credit. So then you have these numbers for each buyer, all right? And then for each of this buyer, there is a date and for the sales to happen. And also there is a ledger built for each particular company. This is called a subsidiary journal ledgers, all right? And there's also cost good incurred. So for cost of good, you also need to consider the total amount for the inventory. All right. So you also need to prove the accuracy of the subsidiary ledgers. So for each individual companies, so you can divide them into different segments, and you also need to pay taxes for that. So the tax issue is not covered in this chapter. So let me just skip that. So when sales is incurred, you also need to consider the returns and allowances as we covered in chapter 5, the merchandise. And after you incorporate those returns and allowances, you would have a finalized. So here is a cash receipts journal. So as you can see, you have all the journal entries. So for each debit, there is a credit. So if you have a sales, and then your account receivable also increase as a debit. You have a one journal entry for each of these companies you deal with. And also you have a one journal entries for each of the transactions for collecting the receivables. So you don't have to go through each of the details. You just need to see the outlook and get an idea what a cash receipt journal look like. So anything that would result in your cash to change, then there should be a journal entry, and you're gonna put it in this cash receipt journal. So these are the accounts and also the explanations, and also how much cash got a debit or a credit. So, and you also have a purchase journal. So whenever there is a purchase, you need to build in the companies you buy merchandise from, and also the terms and also account payable incurred due to the purchases, and when and how much inventory is built up, and where the rest of money go to supplies or go to other accounts. And of course, each of these transactions comes with a journal entry. So these are the journal entries. So these are the journal for an account, a specific account. And you also have a cash disbursement journal. So that's about spending cash. The previous one was a cash receipt journal. That's about receiving cash. So you can see it's only debits right here. When you receive cash, that's a debit for assets. And for a cash disbursement, so it's all credits. Okay, so all credits. So that means when you spend money. So that's another journal made from many different journal entries of many different transactions and activities. All right. So for the journal transactions, first of all, you need to purchase of a plant equipment. You may issue short-term notes or just get payables. And then you will receive the notes for receivables, and also you also have purchase returns and allowances, sales returns and allowances. So this will all build into the journal. Remember why we call them general, because they are not specific. So for any other transaction, they all go to journal. Nowadays, we rely more and more on technology. So you need to have different softwares. So it could be off-the-shelf software, which is the programs readily used that are friendly, that is more generic, and that applied to any companies. And you also have a built-in software that is particularly designed for a company's use, and so we call it integrated software. So that means this accounting software is merged with the existing system of the company. So that's unique. And also need to conduct online data processing. So you will do the online processing and make sure the work is done immediately. And you can also patch the processings and do all the information at a periodical basis, like daily, weekly, or monthly. So you will use the computers to work on the accounting. So there has to be a main server that is served as the hub of all the information. And then there will be different portals for you to work on the information. We call these workstations. So you input the documents, record the transactions, and different accountants have their own different workstations for their own part of the work. And then the whole thing will get to the server, and then it will get to the printer for an overall view of the account book. So nowadays, the enterprises or the businesses are using different softwares. So here, the most widely used software is SAP, that's from a German company. You also have Oracle, that's an American company. So these are all the other software companies that provide accounting softwares. And of course, there are so many of them. Actually, nearly half of the companies have all other kind of software. And you also should know that there's cloud computing. So just like your cell phone, your laptop, and even PC and a tablet. So when they do accounting, it's not necessarily put in the hardware, which means you have to install the software and then get the data run in your own computer's hard drive. Actually, you upload your data and to the cloud, and then there's a system, there's a computational system in the cloud that will facilitate the computation for you. All right, since we will divide our business into different segments, then we also need to calculate the assets ratio or return on assets for different segments. So it's actually pretty standard. You just get the return on assets on the segment basis other than a accumulated basis. So right here, you can divide the segment based on the industry each segment is in, or the location, we call it geographic, and also export sales, and also major customers. So these are the criteria we divide our segments. And again, when you calculate return on assets, you will do it on a segment by segment basis. Okay, so the segment operating income divided by segment average assets, that's pretty easy to do. Okay. So that will be the end of this chapter.